back to Mind Your Biz. This is going to be a slightly different episode where I am on the road, but I did want to talk to you about our typical Tuesday, Thursday stream content, including some news as well as markets. Let's start with a Fear and Greed Index. Current score is 32, down from yesterday's score of 33. Now, if you're watching this on Thursday morning, October 27th, then you'll just be aware that I recorded this last night on Wednesday, October 26th. Now, the overall trend for the Fear and Greed Index, you know from watching my show in weeks past and in months past, I view it as something of a counter indicator, not meant to be any kind of legal or investing advice, any kind of financial advice. But as you see right here, the trend, you can see right here, the trend has been in extreme fear, but then moving up to just fear, right? The score of 33 and now 32. Now, what does this mean? Now, typically in my mind, this is something of a counter indicator, meaning that as the movement is up, we can start to be a little more fearful. Now, we don't have our Bitcoin chart, our trusty Bitcoin chart for this particular view because I'm recording on a mobile device. But the point is that as people begin to become more greedy, less fearful, I think that we need to do just the opposite. So with that Bitcoin price move up over the last 24 hours to 2.75% up, we need to be cautious. Same with the Ethereum price move up. I just received a payment for services rendered in Ethereum as well. I'm going to peg that payment directly to stablecoins immediately. That Ethereum payment, I am not going to hold on to it because I don't want to see a retracement and or see a market response to that brief pop up, right? At almost 5% up. I want to be really cautious about how I hold these coins. Now, on the flip side, Dogecoin has an irrational move up to 14% plus, in part because of the news involving Twitter and Elon Musk's purchase of Twitter. So because Elon Musk is making so much noise on Twitter about the acquisition, most of us suspect that that's why Dogecoin is moving up as well. But as you see right here, the top 10 coins, we'll just not list any of the stable coins. Bitcoin, Ethereum, Cardano, Binance Coin, XRP, Dogecoin, Polkadot, and Solana. They've all moved at least a tiny bit, but none as much as Dogecoin and Ethereum. So beware, it's very likely that these will snap back very, very fast. Top movers are Doge, Clayton, Shiba Inu, and then TWT and Chiliz, right? These are not tokens that I have really strong faith in terms of the fundamentals, except for Doge. Believe it or not, I am something of a Doge believer. I said back in 2016 that those who sleep on Doge are going to overlook generational wealth. And, well, here we are in 2022 with several Dogecoin millionaires that have been made in that time. So I stand by that sentiment. I should probably take more of my own advice. Let's take a look at crypto bubbles to see what the current situation is. This is the weekly performance, the weekly size and weekly performance chart. See right here, there is Clayton right there, looking pretty good at 63% up. Hex also up 43%. Very, very impressive. Current price at 4.5 cents. Now, I suspected that Hex might potentially see a move all the way down to almost 1 cent. I was totally proven wrong. So here we are with Hex moving back towards 5 cents. A lot of Hexicans and a lot of Pulse hopefuls still kind of losing a bit of faith as they're waiting for the Pulse Chain mainnet to launch. That said, the Pulse Chain testnet is live right now, and all of the liquidity provider fees, all of the Pulse X actions you might normally want to take are available simulated on testnet right now, so don't lose faith. Hex apparently is seeing that move to the upside. Ton token as well from Telegram, also with an over 50% move over the last week, just looking really, really strong. Now, the fundamentals there, I don't see them. I was over on Sin City Crypto in their studio talking about this as well. Do I view it as a flat-out cash grab? I don't know. I wouldn't call it that, but I just don't see the strong fundamentals there, so just be careful. But that's our crypto bubbles overview. Let's take a look at the news. Play to die, the new crypto gaming model, makes death in the metaverse real. I think this is hilarious. This is the brief. What if death in crypto gaming could become permanent, just as it does in real life, or just as it does in typical AAA video games, where you would have to start entirely over with brand new avatars and a brand new investment of time and capital, if that's what it took to have NFTs and such. So Dave Stanton proposes a model which allows a beloved character that dies in one game to die forever. And this makes sense with the NFTs that can be burned, right, on chain. And the character is minted as an NFT that can be traded on the open market. And of course, If it's burned, that means it can no longer be used in those video games. This as a rough concept makes sense to me and would increase the rarity of some of the in-game assets that are being used in so many metaverses. It might also help in establishing a more clear-cut tokenomic value for a lot of the in-game assets that are being promoted in these metaverses, right? If you can move to earn, then why can't you play to burn, right? Why can't you move to burn as well with some of these same tokens? It could be true of Step App, it could be true of any of the other move to earn games, and of course any of these video games as well, or these metaverse games as well. But moving on, Twitter loses its most active users and struggles to keep others. Apparently 10% of the most active users represent 90% of daily Twitter activity. Now, does that mean they're all bots? Well, that's not exactly what's being said. But there was an internal report that says they know about the situation but don't want to make it public. Months ago, Elon Musk said that the social network was dying, and I personally don't think that he was wrong. I think that the majority of the activity on most social media platforms, as well as YouTube, is bot activity. And there is the so-called dead internet theory that kind of backs up this same stance as well. And in Elon Musk's defense, he was offering a lot of money to acquire Twitter. And so if 70% or even 90% of all of the traffic on the platform is fake or automated, then why wouldn't he want to renegotiate? I know for my part, I've got at least a couple of accounts that I've set up on Twitter in years past that were just sort of friendly joke reminder bots, and they were publicly identified as such, as automated accounts that just gave reminders to do things like drink water, or reminders to do things like check your horoscope just for kicks, right? That sort of thing can be automated, and it begs the question: why would you want to why would you want to personally invest the time in certain kinds of content, publishing certain kinds of content, when you could automate certain kinds of content, or at least schedule certain kinds of content? That said, it's been taken to an extreme, and Twitter has been automated for the better part of 10 years. So for him to make that claim, it didn't shock me. I don't think it shocked anybody. But Twitter apparently is finally having to contend with that now that the offer is becoming very real from Elon Musk. The UK banks hate crypto. This is part of a little line of content here, a little through line of content here that I think is going to become extremely important as we go. But let's start with this little piece right here. UK banks apparently hate crypto, and that's bad news for everyone. So from Cointelegraph, they say banks in the UK try to block businesses and individuals alike from investing in cryptocurrencies. Regulators should fix the situation, but there's no telling whether or not they will. Apparently in 2018, their Financial Conduct Authority, or FCA, wrote to the heads of the country's biggest high street banks to emphasize the importance of due diligence when dealing with crypto businesses. But that apparently has led to an overzealous enforcement or towing of that line. So apparently, these banks are reasonably concerned with scams, but the current situation creates more uncertainty and prevents most retail participants from even getting started. So it harms market competition because they are overzealous in enforcement. Well, let's move on to some other related news. Crypto lending protocols are trying to mitigate risk from low liquidity tokens. And all of this is related, and you'll see how in just a moment here. But crypto lending protocols try to mitigate risks from low liquidity tokens. This is by Jeremy Nation over on theblock.co. And here's the quick take. It says concerns over exploits cause crypto lenders to assess the fitness for low liquidity tokens as collateral assets. So there's a little bit of a concern that some of these lending platforms will not be able to liquidate the assets being furnished if they're being furnished as collateral. And with limited assets available for collateral on the platform, Euler Labs head risk Seraphim Checker said the systemic risks are reduced for the crypto lender. So there's a bit of a need for caution there. But what happens when the banks are complicit in limiting the amount of initial capital that people can use to begin with, so you can't even get access to any crypto assets at all? Well, apparently in Singapore, the government wants to prohibit retail from borrowing any funds for crypto investing. This is from Mandy Williams over on Crypto Potato, talking about how the authorities have proposed a new set of regulatory measures to oversee the use of digital assets in the country and protect consumers. But the Monetary Authority of Singapore recently published two consultation papers containing suggestions to tighten the country's regulatory stance on digital assets, but specifically a ban on crypto credit. This is a huge concern to me because we're about to go into hopefully, what will be bottom support. We're nearing the end game for this cycle's bear market. And that while I don't believe we are there yet, we could dip as low as $12,000 to $14,000. However, if we don't dip that low, then it means we're pretty close to bottom support now. And, maybe if we still have to go that much farther, it means there's not that much farther to go before we find bottom support. Meaning that crypto credit and borrowing from banks in order to purchase cryptocurrency could be some of the best, least toxic debt that any individual could get themselves into right now or in the coming months. And so Singapore, or apparently the Singaporean authorities, do not want to be taken for a ride. They don't want to let retail win. That, combined with the UK's very aggressive anti-crypto stance, means that we are in trouble being unable to access our fiat currencies in order to get a hold of digital assets and put ourselves in a position to ride all of the possible upside and enjoy all the possible alpha of an upcoming potential bull run. It has me very concerned indeed. Tell me what you think down in the chat. But let's move on in the news cycle. Apparently, most DAOs are restructuring. This coming from Blockworks and written by Jack Kubinek. But apparently Sushi Swap, SafeDAO, and Uniswap have all altered their legal structures in recent months. And these new DAO legal structures are functionally very similar to LLCs. And wow, it's almost as though your boy mineyourbiz has been saying for years that LLCs would be the best fit for this type of business. And even if you do register an LLC with the DAO rider in the state of Wyoming, it's an LLC first. So it kind of begs the question, is it even necessary to designate it a DAO, or could you just register an LLC and then in your corporate formation documents, right, in your articles of incorporation, could you simply designate that there is a DAO structure and then enumerate in those articles of incorporation what those smart contracts are that govern that DAO? Well, that's up to you. I'm not trying to offer you any legal or corporate advice, but if I were you and if you were trying to form a DAO today, I would ask those questions very directly from whoever it is that you're hiring, either as legal counsel or as your consultant. All right, theblock.co also bringing us news of Meta's massive L this year. You thought it was only a few billion? Nope, it's $9.4 billion that the company formerly known as Facebook has taken right on the chin. Meta's Metaverse unit, Reality Labs, lost $3.7 billion in the third quarter this year, the third quarter alone. And apparently the company's losses come on the heels of a hiring freeze, a push towards selling virtual reality technology solutions to corporate clients, and increased shareholder scrutiny. Well, what does that mean? That means shareholders are not just along for the ride anymore. They want to see strategies that actually result in alpha, that actually result in upside for their interests, right? They want to see dividends. They want to see stock splits. They want to see the price go up. And what Facebook has done so far in rebranding to Meta and in launching a metaverse interest has just not cut the mustard. So we'll see what happens. I am not shedding any tears for Meta. We'll see what they have to do. It would be great to see them offer something that consumers actually want, that's such as genuine decentralization. But we'll see. They have to decide that it's something that they want first. And last but not least, from Crypto Potato, here's how much A16Z's largest crypto fund is down from the Wall Street Journal. Apparently, A16Z is feeling crypto winter as well. And this is some of the news that has me ironically bullish. Why? Because I love seeing market indicators and viewing them as counter indicators, right? When others are bullish, I get a little bearish. When others are bearish, I start to get a little bullish. And so when I see blood in the streets, when I see A16Z's blood in the streets, when I see Michael Saylor's blood in the streets, I get very excited. I start to think that it might be time to acquire. It might be time to get those value buys in and start setting my targets. But apparently, the VC's first crypto fund saw its initial investment grow almost 11-fold as of the end of 2021. Following the success of its crypto bets, Andreessen Horowitz went ahead and to create more funds, launching a third one worth $2.2 billion in June 2021 and the latest in May 2022. The decrease is a result of the ongoing market downturn, a decline in consumer demand for some of the A16Z-backed crypto companies, and increased regulatory scrutiny on startups backed by some of the funds. Consequently, the VC has reduced its involvement in cryptocurrency deals. In Q3, A16Z participated in 9 crypto startup deals compared to 26 deals in Q4 of 2021. The bear market adversely affected the company's cryptocurrency investments. Well, as you can see, the bottom line is that A16Z is hurting almost as much as anybody else is in this market. But, my take on it, when I pull up to a stoplight and see red, I am trained to hit the gas because I just view it as an inverse indicator, a counter indicator. Tell me in the comments, are you excited about any of these price movements? Are you as worried as I am that Ethereum is going to potentially whipsaw right back into place? I know I got a payment in Ethereum and I'm thinking of pegging it directly to stablecoins right now. But you tell me in the comments, what are you excited about? What are you fearful about? What are you hopeful for? And do you like this format for the content? Would you like me to do more of this? As always, you're the reason I make this media. Remember to smash like, smash all the buttons, right? And be subscribed. Share this with somebody who needs to hear about cryptocurrency right now as we near bottom support in a bear market. Definitely take care of people. Send this to somebody who you know needs to understand more about cryptocurrencies. Remember, you're the reason I make this media. I love your face. Stay private and mind your biz.